Looking for the scoop on a high quality stock that looks super cheap? Would you like to invest in a company fresh off of a big acquisition that gave them access to one of the best selling products in the world? Want to collect a market beating dividend that's growing at an accelerating rate? Then you have to check out today's video.
He is a best selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel. I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing the world with some of the most sought after and successful pharmaceutical products. Nobody wants disease, and if there's a therapeutic out there that can help eradicate it from your life, you're likely to do whatever necessary to procure that treatment. Well, this company steps into that role and provides the world with some of the very best drugs known to man. And they're profiting handsomely by doing so. So are shareholders, with big and growing dividends flowing their way. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Bristol-Myers Squibb Co., which appear to be trading at a significant discount today. Bristol-Myers Squibb Co., stock ticker BMY, is a global biopharmaceutical company that is engaged in discovering, developing, and delivering a range of medicines to help people overcome serious diseases. Founded in 1887, Bristol-Myers Squibb is now a $140 billion by market cap healthcare giant that employs 30,000 people. Bristol-Myers Squibb focuses on oncology, cardiovascular, and immunology treatments. Fiscal year 2019 revenue was centered on two primary drugs that together accounted for almost 60% of sales, Opdivo and Eliquis. Eliquis is jointly developed and commercialized with Pfizer Inc. 59% of fiscal year 2019 revenue came from U.S. sales. Non-U.S. accounted for the remaining 41%. The investment thesis for a global pharmaceutical company is very simple. With a global population growing larger, older, and richer, demand for and access to top-flight therapeutics is sure to rise. I do not see a future world in which there is less demand for these drugs. One knock against Bristol-Myers Squibb has been its drug concentration. It has historically lacked the kind of portfolio diversification that some competitors have enjoyed. However, the company made a big change in this department by acquiring Celgene Corporation for $74 billion in late 2019. This greatly expanded and diversified its drug portfolio, and it added blockbuster cancer drug Revlimid to the mix. This one drug did almost $11 billion in sales last fiscal year, which makes it one of the top-selling drugs in the whole world. It's the crown jewel for the combined business. The bigger and arguably better Bristol-Myers Squibb now has even greater scale, which is a powerful asset in the biopharmaceutical space. That bodes well for the company's ability to continue growing its profit and paying out a larger dividend to shareholders. Already, Bristol-Myers Squibb has increased its dividend for 12 consecutive years. The 10-year dividend growth rate is only 3.5%, which is slightly disappointing. Honestly, the low dividend growth rate has kept me from covering the stock in the past. That's especially so with this not being a high-yielding stock. The stock yields 3.2% right now. To be fair, that beats the market, and it's 40 basis points higher than the stock's own 5-year average yield. But with a low single-digit dividend growth rate, I'd need a much higher yield to make sense of the numbers. Well, there's been a recent acceleration in the dividend growth rate, with the most recent dividend increase coming in at almost 9%. And I think the new business will be able to sustain something closer to this level going forward. The payout ratio, using the midpoint of the most recent non-GAAP earnings per share guidance for this fiscal year 2020, is only 31.1%. That makes it an incredibly safe dividend, and that makes sense when you consider the approximate 9% dividend bump that came in only a month ago. Looking at business growth, Bristol-Myers Squibb has increased its revenue from $19.484 billion in fiscal year 2010 to $26.145 billion in fiscal year 2019. That's a compound annual growth rate of 3.32%. Meanwhile, earnings per share moved from $1.79 to $4.69 adjusted over the same time period, which is a compound annual growth rate of 11.3%. I used adjusted earnings per share for fiscal year 2019. The company took a number of unusual charges in the fiscal year that artificially skewed results. This is very good top line and bottom line growth in my view. Looking forward, CFRA believes that Bristol-Myers Squibb will compound its earnings per share at an annual rate of 10% over the next 3 years. This would basically be a continuation of the status quo. They cite the Celgene acquisition as giving the combined business a healthy pipeline and a portfolio of developed drugs with promising long-term growth potential. Regarding the pipeline, the company has over 50 compounds in development as of November 2020. The acquisition broadened and scaled the business, catapulting them into a true biopharmaceutical powerhouse. However, this acquisition did come at great cost. The additional debt load and increased ongoing costs via SG&A are not insignificant concerns. These headwinds will likely weigh on the business, limiting growth to a degree. It's also worth noting here that patents on Revlimid begin expiring in 2022, with unrestricted competition slated to begin in 2026. I think CFRA's near-term earnings per share growth projection is fair, and that would portend similar dividend growth, which speaks to the acceleration I noted earlier. A dividend growth rate at or near the double-digit mark is awfully nice when you're pairing that with a 3% plus starting yield. Moving over to the balance sheet, the company has a solid financial position. However, this position has markedly deteriorated after the Celgene acquisition due to debt funding much of that transaction. Bristol-Myers Squibb has long had a fortress balance sheet, but they definitely leveraged the balance sheet to scale the business. Long-term debt, for example, went up more than sevenfold between fiscal year 2018 and 2019. The long-term debt to equity ratio is 0.84, while the interest coverage ratio is under 4. That latter number is concerning. However, the Celgene acquisition completed in late 2019, prompting a state of flux for the balance sheet. I think the interest coverage ratio will rise as things smooth out and normalize. Profitability is robust. Over the last 5 years, the firm has averaged annual net margin of 13.45% and annual return on equity of 18.86%. These numbers are great, but I believe they can and will get better. There really is a lot to like about Bristol-Myers Squibb. I haven't covered the stock before because of modest dividend growth, but this could be a dividend growth monster that's just now awakening. And with global scale, R&D, IP, and patents, there are competitive advantages in place to protect the business. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. There exist near-term concerns over patent protection around Revlimid. The weakening of the balance sheet must be rationalized by a lot of growth from the acquisition, which has yet to be proven out. Any major changes to healthcare in the US, particularly as it relates to drug pricing, would impact this business. And while the drug portfolio has broadened out, Bristol-Myers Squibb remains concentrated around only a small handful of highly successful drugs. With these risks spelled out, I still think this stock could make for a fantastic long-term investment. I think that's particularly true with the valuation being attractive right now. The stock is trading hands for a price-to-earnings ratio of 9.8 based on the guidance midpoint for fiscal year 2020 non-GAAP earnings per share. I'm using that guidance because of unusual charges that have caused massive recent fluctuations to GAAP earnings per share. If that's anywhere near an accurate look at the valuation, this stock is extremely cheap. We can also look at cash flow and move past those adjustments if we want. The current price to cash flow ratio of 11.0 is well below its 3-year average of 14.1. And the yield, as noted earlier, is materially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This is a slightly lower dividend growth rate than I've assigned to some of the other biopharmaceutical stocks that I cover. Comparing this to the company's long-term earnings per share growth rate, the recent dividend raise, and CFRA's near-term earnings per share growth projection, it's downright conservative. I think this conservative stance is warranted. While the Celgene acquisition is exciting, it's unproven, encumbered the balance sheet, and exposes Bristol-Myers Squibb to near-term patent issues. The company could certainly outpace my mark, but I'd rather err on the side of caution. The dividend discount model analysis gives me a fair value estimate of $69.91. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis analysis as it simply substitutes dividends and dividend growth for cash flow growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Bristol-Myers Squibb as a 3-star stock with a fair value estimate of $68. Cfra rates Bristol-Myers Squibb as a 4-star buy with a 12-month target price of $75. I came out very close to where Morningstar is at. Averaging the 3 numbers out gives us a final valuation of $70.97, which would indicate the stock is possibly 15% undervalued. Here's the bottom line, guys. Bristol-Myers Squibb Co. is a global biopharmaceutical company that just took on an exciting acquisition which could propel future growth on the back of one of the world's best-selling products. With a market-beating yield, accelerating dividend growth, a low payout ratio, more than a decade of consistent dividend increases, and the potential that shares are 15% undervalued, dividend growth investors should consider this stock before it races higher. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.